Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
This is put in a little better, maybe like outline format, I guess, in terms of how we define the fundamentals or the mind of the market, the stuff that we think about. What are really the key fundamentals? I mean, there's all kinds of stuff out there that we're told drives currency prices, but in the end, all the analysis we do really revolves around these two things. It's interest rate, differentials against the various currencies. Interest rate differentials just means the difference between interest rates. For example, the Australian currency is short-term yields are about 3.5% in Australia. The U.S. is about 0. So there's a 3.5% positive differential favoring the Australian dollar. That's a very powerful driver for a currency. The higher the yield differential and everything else being equal, it's a positive driver. In terms of the currency world, there's all types of things out there, as I said, that appear to be correlations, and you can hang your hat on at different points in time and different points in the business cycle. But if you look long term and you really boil the fundamentals down, all the stuff we look at, these are really the two things that have always been the most powerful and always operating in the background to drive currency prices over the intermediate to long-term basis. Right now, interest rates are playing a powerful role. As you know, the interest rate differential for the U.S. dollar is negative across the board, especially on the short end of the curve. The U.S. has the lowest interest rates in the world out to 6 months, even lower than Japan. There's where you get into the idea of borrowing the U.S. currency because it's so cheap and reinvesting elsewhere. So here's a factor where if you focus on interest rates and only interest rates, you can see the U.S. dollar is losing out on that one powerful fundamental, and it's a powerful driver. But interest rates can't be judged purely at the nominal level, meaning their current rates. You also have to consider what the consensus thinking is, and you're doing this as you do your fundamental analysis. What's the consensus expecting in the future? And that's a big part of it. If they don't expect the Fed to raise anytime soon, anytime out to 2011, you can bet that if the Fed turns around in the next meeting and for some reason, and it doesn't appear to be, and that would be the surprise, and hikes rates 25 or 50 basis points, that's a massive surprise to the market. But because you've looked at the fundamentals and you know that the consensus isn't expecting anything and something does happen, that's a big surprise. So you can expect the dollar to move very, very quickly on that big surprise, big change in expectations. And again, just knowing the fundamentals would allow you to make that trade without even looking at the charts or anything else. Economic growth, again, is also the other real powerful driver. In general, you can say that the interest rates, because of short-term money that's always sloshing around the world in the global capital markets, it's referred to as hot money, that's always going to the highest short-term yield. So you see money sloshing in and out of markets for the highest yield advantage. Economic growth plays a little different role. It tends to be the longer-term investment side of the fence or fundamental side, which I guess you can think of in general as a foreign direct investment if we had to define it. This is investment flow that's going to come into a country based on economic growth in the future, economic growth prospects. Obviously, these two tend to self-reinforce each other. For example, if growth is real hot in a country and starting to grow, what would we expect? We would expect interest rates to go up as growth goes up from the central bank to try and cool down inflationary concerns, those types of things. So they tend to self-reinforce. So when you can find a currency that has a positive interest rate differential or a low interest rate that's moving to a more positive interest rate differential and it has economic growth, it means that it's pulling in both hot money and foreign direct investment at the same time. The best current example of that is Brazil. As we know, the Brazilian authorities are trying to slow down capital flow into the country. It's coming in so fast. And why is it coming in so fast? Because Brazil's interest rates are about 8.5% on the short end of the curve. Their economy is growing and expected to grow about 4.5% next year, which just, blows away any of the industrialized countries. So you have that type of yield and that type of growth advantage That's why the Brazilian real has soared against the U.S. dollar and the other major currencies this year so far. So that's a great example. I guess of the major currencies in the world, we still have to point to Australia as the currency that has both the yield differential and economic growth behind it. The economic growth, of course, flows from China and the massive demand from China still as they continue to stimulate their economy and grow. So those are really the key factors that I think you've been able to hang your hat on all the time over all the different cycles. In the current cycle, we have a very odd situation going on in that we have correlations that are so extremely tight, and I'll get to that a little later. We haven't always seen that before, but we've always seen these two things, these two real underlying fundamentals that tend to self-reinforce as drivers. So those would be your general focus, and just kind of focus on those major things that drive these two events, not getting too crazy with this. You don't need to. We're thinking of global macro, a top-down view. A top-down view is you're just trying to look at where money's flowing based on these overall fundamentals. Because currency, if you get in the right ballpark, that's all you're trying to do. Get yourself into the right ballpark and make the pick. You can never be perfect in this because there is nothing perfect in terms of the analysis. Currencies don't produce balance sheets and income statements like stocks do, so we can't do that type of thing to a degree. As I said, we try and use this information to understand what the consensus view is, which is really the most likely or the current view of the consensus, and then think of something that's probable, which allows us to move if these fundamentals start to change, if the analysis in the background starts to change, and I'll give you an example of that hopefully as we go forward in one of what we did in the past. But that's the reason for developing alternative views based on the fundamentals. You can't really develop too many alternative views based on the technicals. I mean, you can have a technical view in different but the fundamental view, I think, especially in the intermediate to long term, is really what you want to, focus on to give you some ideas. It doesn't mean you can't integrate all your technical analysis, but I think if you have this type of mindset in terms of the fundamental side, it will really enhance and provide some nuance to your technical analysis. Dollar scenarios. First thing we do in terms of the fundamentals, really we build the dollar scenarios, our most likely dollar scenario and our probable dollar scenario. Right now, of course, the dollar scenario number one is the consensus view. The dollar goes lower on lower yield and lower growth. Makes sense. Neither one of those is supporting the dollar. We have a plausible alternative view that the dollar rallies on risk, and I'll get into that. Market themes in general, we think of market themes, as I just said. I guess the simple market themes that are constantly playing out now because of the correlations are this idea of risk appetite, risk aversion. Risk appetite, people are moving to currencies that are growth currencies, high yield currencies. Risk appetite, money comes off the table out of the high yield currencies and buys the anti-carry trade currencies, the funding currencies, when people want to hide. And I'll explain that if you have any questions on that. And we also try and develop currency scripts for each of the major currencies. We look at, for example, what's going on in the UK. We look at the interest rates, and we look at the background fundamentals, and we say, okay, UK looks like it's in trouble because of this, therefore A, B, and C. But what if? And we try and build those, again, these same most likely and probable scenarios for each of the currencies. Now, we do that, and we do this all day long, so we can do that. You don't have to do that. If you do this at a level, I think, just at the dollar level in general, that in and of itself, I think, will be enough to help you make your decisions and support a lot of your technical analysis.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.